Hey everyone, thanks for joining us again. Today we're talking about Introduction to Charts. Now these couple of chapters are new for 2021. Really nice because it's a lot more concise than previous chapters were in previous years. So we'll go through these as a lot of learning objectives, but it's all really simple stuff. So this is really the basics of charting that we're talking about. Really, the most important things are obviously knowing how these charts are constructed, what data they're using, how the data is represented, and then making sure that you remember those for the exams. So let's jump in and have a look here at the learning objectives. So explain how a technical analyst uses charts to summarize price action. Basically, we're talking about how do we create the data? How do we go from thousands and thousands of ticks streaming through, and how do we create charts from that? Discuss the advantages of reviewing price as in a chart format. That one's pretty easy. Obviously, it summarizes a lot of data. That's the key takeaway there. Identify the 4 basic price points represented in charting. We'll talk about those. Describe how to construct line, bar, and candlestick. Identify the components of an individual candle. And we'll talk about that also in the candlestick sections, but we touch on this. A little bit of overlap with those chapters, but that just is good reinforcing. Review information available. Describe what's meant by data interval. And the whole sampling concept, and then define range as it applies to bars and candles, and then define fractal and the fractal nature. We talked a little bit about that in earlier chapters, but we'll touch on that again here. All right, let's jump in and have a look at our first slide here. So we have the chart construction. So at the end of the day, the price is simply a point where buyer and seller meet and they agree that this is the fair value for this security. Now, remember when we talk about this, we've got thousands and thousands of buyers and sellers, all who have their unique needs. If I'm a long-term buyer and I've held this thing for a couple of years, I may be selling because I think, the market's pulled back, it's at a support level, or whatever reason. I've done my research and for my needs, I'm happy to sell. But for someone else just coming into that security, they're looking at a pullback saying, hey, this is a great time to buy. And I may only hold it for the next 2 days and then sell it again. So just remember that it's not that one's right and one's wrong. The buyer and the seller are coming to an agreement because they have their own unique needs and their unique goals and their hold times and all sorts of things like that. But that's where the price is. It's where 2 people agree on a fair price for that security. Happens thousands, sometimes even millions of times for securities every day. And if we were to try and analyze all of that, we'd go crazy. So the prices only go up when there is demand. So when we know that there is a lot of people there and they're saying, I want Microsoft, I want to buy it, and they're buying it at market and buying up all the asks that are out there, then we're going to see prices going up. In the similar way, if there is a lot of supply and not many people buying, then we can see that prices will start to go down as well. We'll talk a lot more about that as well in the new volume chapters when we talk about strong demand and strong supply and weak supply. It's really important in determining trends and identifying when trends. We talked about Dow Jones in chapter 2 there. We talked about how the primary trend and the secondary trend, and how do you know when a secondary trend is not the start of a new primary trend down? And the reason that we look at is volume. So we always look at that. We use charts to summarize all the trades. So rather than looking at those thousands and millions of trades, we look at charts. And the charts then tell us what a summary that we can glean information from. We can get an idea of trends and things like that. Charts are also a great communication tool. You know, a lot of our clients are professional analysts that support portfolio managers, etc. And charts are the great way for them to be able to go to that portfolio manager and say, look at this trend, look what's happening, look at these indicators and how they correlate with things that are happening in that security. So it's really good. You know, one thing I always like to say is fundamentals move the market. Don't ever listen to anyone who says fundamental or technical, one's right, one's wrong. No, that's a load of rubbish. Fundamentals move the market. When there is fundamental information about what a company is doing, then that's going to bring in the masses of fund money, which is going to either rise or sell or lower the price of that security. Technicals allow us to take advantage of those fundamental moves. So we can get in there and we can have our signals. We can say, hey, something's going on that maybe we don't know about, but the technicals allow us to do that. And so that's, you know, a big thing I like to remember. So this is where charts construction, really, really important. The advantages of charts is that we're basically removing all of the noise out of the chart. You know, we're getting rid of all of that. And again, that depends on time frame. So if you're dealing with a tick chart, you're going to see all the noise and you're going to be maybe trading the noise, and that's fine. But when we're talking about daily or weekly or even monthly charts, you know, we remove all of the noise out and we just focus on the main trends which are going on. The charts tell us a picture which can be lost when we look at the individual trade. So it gives us that overall view. And I think that's the key point to really take away from this as to what are the advantages of charts. It's that overview and removing the noise from the market. They allow us to identify trends in the market, which we've already talked about. So the first one here is line charts. So really all we're doing is we're taking the closing price, let's say on a daily basis like this, and each of those you can see represented by the dots. So that's the closing price in Apple on a daily chart through January and February of 2021. And then what we do is simply just join the dots with a straight line. And that's really just all that a line chart is. Now, obviously, in a day, we have our opening price and the market may go up, it may go down. And, you know, we have all of this stuff that goes on in the middle of the day, but all we care about is that one price. And you can see that it gives us this way of being able to say, hey, the market's trending up here for a short period and then we're coming down. We can see a secondary reaction to, you know, a downtrend here, but then it reestablishes and goes down again. Another secondary reaction and continues on. So we can easily identify that by looking at the chart and looking really at what is just a summary of what's been going on over this period. Now, if we were doing it for weeks, we're doing it for months, we would do the same thing. We just take the last trade, ignoring everything that went on between for that time period. We'll talk a bit more about that in a moment. While the detail of what happened during the day is lost, we see the general trend, making sure I didn't miss any notes here. The closing price is not more important. It's not that we're saying this is the most important price of the day. Some may argue that it is, but I wouldn't say so. It's really just saying that we had to pick a day, a price to represent that day. And the closing price is usually what people would look at. And it's the price that gets reported in newspapers the following day, you know, back when we used to find our stock prices in the newspaper. And so that's why, you know, we choose the last price there. But it's not to say that that's more important than the open or any of the other trades that go on. It's just the time that's chosen or the price that's chosen there. All right, so bar charts, we are looking at this and we're saying, okay, the open is our first trade in that day or that week or that month, whatever the time may be. And then we have our high and our low and our close. Now, we don't know the order that the high and the low occurred in, but look, for this chapter, and all you need to know right now is that we have our open, it's the first trade. The high is the highest recorded trade during that period. The low here, obviously the lowest, and then the close. And so, you know, the different variation there with the open lower than the close. On some indexes, you won't see an open. So there's quite often, we get some data sets where we've just got a low, a high, and a close. Usually that's when the open is exactly the same as yesterday's close anyway. That's when we see that happen. But for the most part, I think you're always going to see that. I think even in Optuma, we basically throw an open in and just set it equal to the previous close when that happens. So the period represented by the vertical line here. So when we look at this vertical line, that is the whole day. That's all the prices that happened. And so this is what we call the range. Whenever we're talking about the daily range or anything, or the weekly range, depending on what the time frame is, we're talking about basically the high minus the low. This is the range of the day. Candles, again, we'll talk a lot more about candles in the later chapters, but we're using the same information, the open, the high, the low, the close. So that learning objective, what are the 4 pieces of information that are important? It's the first price of the day, the highest price, the lowest price, and the last price of the day. They're the 4 that we use. Same here. So we've got our high and our low. Of course, that's our range as before. Our open here, which is the first price, and our close. Obviously, the difference is with a candle is that the body is going to be black, or it's going to be open and white, or hollow or solid is the way I like to think about it. So a solid candle is heavy, it's like lead, and then that's just the way that I remember that the close is at the bottom because the price sunk because it was so heavy. A hollow candle is like a balloon and open and hollow and light, and so the close must be at the top because it came up. I'm sure you're going to hear me talk about that in the candles as well. Remember, here we call this our shadows. We have an upper shadow, whichever, when the high is above the open or close, doesn't matter, and we've got that line going up, that's our upper shadow. Similarly, our lower shadow, and we call this our real body. So you're going to have to know those terms, and again, we'll talk about that later. The advantage of candles over bars is that you can look at a candlestick chart and you can see, let's say, a whole bunch of bars, or candles, I should say, with solid bodies. And then straight away oh, they're all closing low. Whereas on a bar chart, you've got to look carefully and say, where's that little tick, for the close, and what's its relationship to the open? Candles make that really easy to see that, okay, this keeps, not only are the days going down, but the intraday activity is that it's closing lower than the open. And so that's really handy there. Okay, so now talking about data intervals, obviously all of those that we were showing then were on daily charts. So, and again, that's probably the most common. Most people will start at a daily chart, but we can do weekly charts, we can do monthly charts, we can do 5-minute charts, we can do, 5-second charts on some markets. So whatever we use, that is our data interval or our period. And in some respects, it's kind of like a sample, because if we were to think again of those millions of trades or thousands of trades that are happening every day and the market's going up and down, all we're doing is we're saying, okay, I want to sample. I want to take a sample and then I want to measure that. And then I take another sample and I want to get the open, the high, the low, the close. Really, that's what all of our charts are. They are samples of all the individual trades that have gone on throughout the day, or the month or the year, whatever the time frame is that you're looking at. So the basic concepts of technical analysis can be applied to any time frame, and that's one of the advantages. Many of the techniques we have, and again, this is what Dow was talking about with Dow theory, the primary trend on a weekly chart, which may last years, when I look at a 5-minute chart, the primary trend may last a couple of hours, if that. And so we can use a lot of this analysis in this fractal way, where whatever we do at higher time frames, we can do down at lower time frames as well. But basically, the way that you choose depends on your investment horizon and your tolerance to risk. For instance, if I was trading weekly positions, well, I have to have a fairly sizable tolerance to risk. And, when I count on the volatility of that security, I need to know that I can withstand the normal volatility. Now, if I can do that on on a weekly basis, and I've got enough capital to support that, then great. That's fine. I can do weekly trading. And I'd have to throw out there, after 25 years of working with clients from Wall Street right down to private traders, particularly in the private trader space, the people who survive the longest, now I'm measuring that by the people who are using our services the longest, end up being the people who look at weekly charts. Intraday people rarely last more than 1 or 2 years. There's going to be some people who are going to be the exception to the rule, but it's so rare that we see people last many, many years doing real-time trading. So if you're a trader, take that as a free piece of information and do what you will. But see, where this becomes a real problem is that if I don't have much capital and I don't have the tolerance to withstand some volatility, then I may get into trouble, and I can't have a weekly position because I'm never going to get a return out of that. And that's what drives people down to the shorter time frames. But the same principles work. I think that's the key thing, the key takeaway from this. In each of our charts, the open, high, low, close are a summary of all the trades that happened within that period or that data interval. All right. So looking at a couple of different time frames here, we've got a 60 minutes. This is the E-mini trading on the CME. We've got the 60-minute chart here. We've got the daily chart, we've got the weekly chart, we've got the monthly chart. Now I set all these up. Now in the text, you'll see that they've set them up with 2 years of data. And it's a really good example because when you look at the text, you can see that it doesn't matter which time frame you're looking at, you're seeing the overall trend and it's the same no matter what time frame because of the amount of data. Because software is obviously going to say, well, if you give me 1,000 data points, I'm going to fit that in that range that you've defined. Or if you give me 10,000, I'm going to fit them in. And so that the general shape of what you're looking at is going to be the same. What I've done here, though, is I've said, no, I only want to show, I think I set it to 200 bars. So this is going to be 200 months, 200 weeks, 200 days, maybe it's 100 actually, looking at that, and let's say 100 minutes. So 100 for each of them, 100 months, etc. So what I can look at then, what's really obvious to me is I can look at this monthly chart, get this overall primary trend of what's happening. I can then look at the weekly, and obviously this big drop here at the beginning of 2020, we can see that here, and we can see the extra noise. This is a lot smoother coming out of there than what happened on the weekly. And then I can come back to the daily. Now I'm not going to see the beginning of 2020 anymore, but I can see, this run here, and I can see that there as we go. So you can see that as we go in, we get more and more information, more and more noise. And again, it comes down to your investment horizon, which is best for you. So we have the same number of data points, and that allows us to get an idea of the trends on those different. So, one way we would look at this and say, okay, this is where the primary trend's going. You could almost argue that weekly is like the secondary trend, and then daily is a tertiary trend. We can look at it in those sorts of terms as well. All right, so as I said, this is a really short chapter. How do we use charts to summarize price action? I think it's that whole sampling. We're looking at reducing the noise, and we are looking at being able to determine the trends. Determining the trends is one of the primary reasons for doing that. Of course, then we're going to talk a lot more about technical indicators, and all of those use that sample data as well as bars and candles. 4 points: open, high, low, close. How to construct a line is just close to close. Bar and candles, all 4 data points are used. The individuals, the real body is always between the open and the close, and the shadows are going up to the high and the low. Reviewing the information available, that again is trends is the big answer to that question. But you can also talk about the solid body versus a hollow body as well. The whole point of a data interval, think of it as sampling. You know, we're taking those samples out of all of the trades that are happening and getting a general idea of what's happening by using that way. Range is just what they're talking about here, is the low to the high. So high minus low is probably more accurate. So we're taking that, and that's our daily range or our weekly, whatever the period of your bar is. And then of course fractal is this whole notion that I can start at a monthly and I can take my analysis down and down and down into lower time frames, and many of these same principles hold when I'm working at different time frames. It's good to have a couple of time frames to give you context of where the market's going, particularly if you're trading shorter time frames. Then you can take all of the trades which are in the direction of the general trend. You know, it's like, again, Dow and many others will say, don't trade against the primary trend, always trade with it, because that's where the most power is going to be. So it's good to have the big picture as well as the time frame that you're doing most of your work in. Whether it's as a trader or as an analyst, the same principle holds. You need to be able to look at different time frames to get a much better idea. Okay, so that's introduction of charts part 1. We'll continue on with part 2.